Good evening, everyone. Thank you for joining in today. This is Sahil Kapoor. I head products and market strategy at DSP. Today, I think it's going to be an extremely interesting session. We're going to talk about something very, very special. Investing in tech companies that win. It's a topic which is very important given what has happened over the last 6 months to 1 year. A lot of volatility in tech names and frontline indices haven't really moved a lot. But under the hood, there has been a lot which has changed. And investing in technology, it has given handsome returns to a lot of investors over time. But within technology, there are so many diverse set of sub industries, and there are so many styles to choose from when it comes to investing. And when you look at NASDAQ and other benchmarks, they have shown such consistency over the last 14, 15 years that not many active managers have been able to beat them. So today we are going to go deeper. We are going to go and do a deep dive into tech investing with someone who has done that for over 2 decades now, and probably better than anybody else. My guest for today is Mr. William de Gale, fund manager at BlueBox Global Technology Fund. William has spent about 20 years at BlackRock and its predecessor companies, covering the technology sector, a portfolio manager since 2000, with sole responsibility at times for the AUM in excess of about $6 billion. From 2008 to 2017, he was the sole portfolio manager for BlackRock's offshore global technology fund, achieving top decile performance. And prior to BlackRock, William served in the British Army. He had already started his career in finance by previously qualifying as a CA with Coopers and Lybrand. He's an exceptional investing mind, and what sets him apart is his investing acumen and his clarity of thought, I think, which all of us would want to cultivate. A very, very warm welcome to you, William. Very, very happy to have you today.
Thank you very much. Pleasure to be here.
Thank you. William, I want to just, deep dive and go deeper and start with a very, very basic questions. One thing that we've heard again and again from a lot of people recently, that technology is in a bubble. That the rally that we've seen over the years. What is your take on that? Do you think technology is in a bubble today, or probably it is still going to outperform?
No, I don't think it's in a bubble. I think there is a bubble in equities, but the one place it isn't in is technology, and I'll come on to why I think that. Essentially, technology has had the most extraordinary 10, 12 years of relative performance. I mean, it's outperformed global markets pretty much every quarter since 2008, to the extent that no one really asks why now. They just assume it outperforms, but no sector has a right to outperform, not even tech. And the reason this is happening is essentially technology is responsible for all the profit growth for the entire equity market over that period of time. So I'm just going to put up a quick slide which explains what I mean by this. So if you could pop the slide up, please. So this is a Goldman Sachs chart, and it essentially, the blue line shows the total profits of actual earned profits. So this is historic, this is not forecast, this is GAAP profits, the earned profits of all large cap US tech companies added together, the pale blue line. And the dark blue line are the total profits of all the world's large cap non-tech companies added together. And they're indexed, so they're effectively on 2 different scales. But you can see that the non-tech companies, the vast majority of the market, have not grown their profits materially since 2006. So that's 15 years without profit growth for the vast majority of the market. And in that time, MSCI World, broad global markets, has far more than doubled. And as you can see, tech companies have increased their profits by around 600% over that period of time. And that immediately explains why technology has done as well as it has. If tech hadn't outperformed, when it's responsible for all the profit growth for the entire market for 15 years in a row, essentially, there'd be something very odd going on with markets. So tech has outperformed the rest of the market because it's the only bit of the market which has actually seen profit growth. And if you look at the strength of that performance, it's quite striking how well tech has done. I'll show you a chart. We normally look at market cap weighted charts, but in tech, that's very distorted by the absolutely enormous mega cap. So I'm going to show you an equal weighted version of the S&P Tech Index. Hopefully that's come up on the screen.
Yeah.
And this is on a log chart. So those red lines are 15.2% growth all the way along. So what this chart is saying is that the average US large cap tech stock, which is what this line represents, has grown its stock price by 15% a year, pretty much every year, without fail, since 2009. And in 2020, the COVID pandemic has pushed everything back up or it's given a one-off boost. It's pulled all these business cases forward in technology by a few years, and now it looks that it's going to continue at that 15% growth rate into the future. If you do anything for 12 years in a row with a 15% growth rate, surely it's getting more expensive, getting too expensive. So people are saying, is this a tech bubble? But the answer is no, because I go back to the previous chart, and the slope of that pale blue line is exactly the same. It's 15% a year. So the average US technology stock has gone up by 15% a year, every year, without fail, since 2009, because its profits have gone up by 15% a year, without fail, every year since 2009. Why have these companies gone up? Because the rest of the market has gone up as well, but without any profit growth for 15 years. So that's what I mean by there is a bubble, but it's everywhere but tech. Because what is in here are the disruptors and the companies being disrupted, the Teslas and the Volkswagens, because Tesla is not a technology company. Tesla does not sell technology, it sells cars. So it's down here in consumer discretionary auto, along with almost every other disruptive company in the world. And they collectively make no money. They spend a lot of money, they don't make money, and they're destroying the business models of the companies that did make the money before. So that's why the profit of a lot of these industries is stagnating, because it's essentially being transferred by all this spend on technology to the tech sector, what we would describe as the enablers. So these are the disruptors and the companies being disrupted, and these are the enablers. And we focus our investment on that, which, looking at this chart, looks pretty obvious to me. But why is this happening? Because up until this point here, these two charts basically traded in parallel. So tech would do a bit worse, a bit better, a bit worse, a bit better. And then suddenly the dot blue line goes sideways and tech absolutely spikes up. And that has to be explained. So what is going on here? Something changed. And essentially, in my view, the whole way that technology operates changed around here from around 2005. And essentially what happened is the model of technology was fundamentally changed by the connection of systems to the real world. So we can probably come off this chart now, but up until then, computers, which are digital creatures, they have no understanding of the real world. They relied on human beings to feed them data. We typically do with a computer, a keyboard, or something of that sort. A human being would basically type something in that the computer could understand. That would translate essentially an analog problem from the real world that we live into a digital question the computer could understand. And at the other end, the computer, after doing something frightfully clever, would reproduce a digital output on a screen, on a printout. And we human beings would read that, and then we would act on the world. So we were the input and output device of the system. But what really changed from around 2005 is the computer began to come out of its box and interact directly with the real world. So the Internet of Things is a big element of this. The system is no longer relying on a human being to stick information in with a keyboard. It can read a little tiny aspect of the world directly for itself. And at the other end, automation, robotics, the system is no longer just suggesting what we human beings do. It's doing it. The computer's changing the world directly. So the human beings have essentially taken ourselves out of the loop. We are no longer the input and output device for that system. We're just supervising it. And if you take the human being out of the system, processes run millions of times faster, because we were by far the slowest bit of that system. And if processes can run millions of times faster, then hundreds of times more applications become viable. Things that were simply impossible in 2000 are now just very difficult indeed. And the tech sector is all about very difficult indeed. That's what the sector does. So essentially, this single break was taken off all of technology at the same time from around 2005. And every single one of those exciting applications that we are using every day that are changing our lives, our personal lives, business, government, military, healthcare, whatever, all these new applications would not work if there were still human beings in the loop, sticking the information in or reading what to do next on a screen. All of them rely on directly connecting systems to the real world. So this break has been taken off everything in our lives at the same time. And that's why technology is exploding all around us. We're not just imagining it. There is more going on at any point in anyone's life before. And all of it is enabled by this direct connection of systems to the real world. And once you understand that, investment suddenly gets an awful lot easier. And also, you understand that this change can go on for a very, very long time, because every time you have a new application that's enabled by the direct connection of systems to the real world, it might enable a further range of applications, each of which can enable further ones again. So you get first order effects, second, third, fourth, fifth, washing out through the economy again and again and again. And it just takes a very long time for that to come to a conclusion. So in my view, we've got a long time before technology stops absorbing almost all the profit growth from the whole market.
Interesting. So I think you answered one of my questions, which I was going to ask, that it's still a very long time, when till this trend plays out, where technology eats out others' profit. And where do you think we are in the cycle? Is this like a 50-year cycle, and we are at the beginning of it, or we don't know what could be the longevity of this cycle?
So I don't know where it will end, but there's certainly no sign of slowing down at the moment. So it's definitely multiple decades. So this is a similar sort of order of magnitude, in my view, to something like Moore's law. That
Right.
you can shrink semiconductor designs reliably every 1.5 to 2 years, and that remained in play for 50 years, 45 years, something of that sort. I mean, it's sort of fading now, but it was in play for a long time, and that change can have an impact for a very, very long time, because it enables one thing, it enables another thing, enables another thing, and in the meantime it's being enabled by new chip design. It just goes on for a long, long time. So I think we're still probably fairly early in this, even though I'm saying it started in 2005. So it really got going around 2010, in my view. That's when you see the impact on a huge range of different applications.
Understood. Maybe it ends when technological singularity is achieved. Who knows? But William, one very important, crucial question. You explained beautifully why technology, I think, is the flavor, and probably it's a mega trend which is going to go on. How do we capture this? What is your investment framework, which works to capture this very, very important trend? And what is your approach to technology investing?
Okay, so the key is to work out which of the long-term beneficiaries of this, and not just focus on the short-term stuff. So if we go back to that chart again, because I think this is the single most important chart in all equities, in fact, in all markets, arguably at the moment. So which of those two lines do I want to concentrate on an investor? I probably don't want to be in the dark blue line. I want to focus on the pale blue line. But as I just said, all the disruptors, the exciting companies that are changing the world, that are using technology to disrupt industries, they're all down here in the dark blue line. These are the enablers. These are the technology companies that are selling technology to those disruptors and all that competition and everybody else. And that's where the money is going. So the disruptors do not make money. The disruptors spend money. That's the nature of disruptors. They're not tech companies. They're companies that are buying technology and using that technology to disrupt a different industry. And then all their competitors have to copy them, or they'll go out of business. And from then on, that technology spend, that new disruptive technology, is just a cost of doing business for all the players in that market. I don't want to get involved in that, because net, there's no money being made there. Lots of companies are going to go under, and the ones that win only win in a revenue sense. They don't make money. They usually just spend money. They continue to make a loss pretty much forever. So I just don't want to get involved in that bit. I want to focus on these ones here. So you focus on the companies, the technology companies that enable all of that disruption. And it's a very clear set of companies that are incredibly profitable, and where those profits outgrow the market year after year after year, because they enable one disruption after another. So they lost a really long time. So that's where our main focus is, to find those companies, make sure they're extremely profitable, that those profits can outgrow the market, that they're big barriers to entry, that they're feeding into something that's a long-term positive trend. And then you just hold them for 15 years and watch them go up. And you don't fiddle with the portfolio at all, because what that Goldman chart is telling you is, don't fiddle with the portfolio. Just buy the best bits of the blue and watch yourself outperform everything else in the market, while everybody else fights over this stuff, which is a less than zero net sum game, in my view.
Understood. William, will it amount to buying companies who create shovels when there is a gold rush? Is that a right comparison?
Absolutely. So I understand the first millionaire from the California gold rush was not a gold miner. He was a journalist. First of all, he bought every pick and shovel he could find in Northern California. Then he published an article about gold being discovered in the hills in California, and he became a millionaire almost overnight. That's what we're doing. We don't care which gold miner hits gold, because most of them don't ever hit gold. They just run out of time. We are going to sell them the kit to do what they need to do. And that's it's a very old-fashioned, boring business model. It works incredibly well, and no one else is doing it in tech. So no one else looks at technology in this way. They are all obsessed with those disruptors, the stuff in the dark blue line. And that's collectively, that's a waste of time.
Understood. So the idea is to find these enablers which are profitable, and as you said, maybe it's some sort of boring to look at, but they are very profitable.
Yeah.
Question is, how do you value these enablers? Could you take us through some
Mm.
examples that you've seen over the years?
Yes. So surprisingly, I don't feel I need to make I don't make big calls on valuation. So we'll never buy one of our companies just because it's cheap, or a company just because it's cheap, because value investing simply does not work in technology, in my experience. And we'll almost never sell a stock just because it's expensive. If one of our companies does really well, we just take half the money out. And if it does badly for a while, we'll look at it and say, is this risk? Is something dramatic changing? Is this business case damaged or under threat? At which point we'll sell it. Or is this just normal volatility? Because volatility and risk are completely different things. People think of them the same thing, but they are totally different. Volatility isn't a question about that long-term business case. It's basically saying volatility is the natural fluctuation of a stock price around a long-term trend. And if that trend is positive, then volatility is fantastic. It is your friend because you can trade against it. So that's what I'm saying with the basically, we hold on to our stocks, we just hold the position. Then if they underperform for a while, we look at them. Is the story still solid? Is this just volatility? If it is, we double them. So we just trade against that volatility. We're not too worried about how expensive the individual stock appears, because absolute valuation in technology is virtually unknowable, in my view. If you think that in theory, the value of a company depends upon the value of its discounted future cash flows, there are essentially three factors that affect that valuation. The first one is, what return can that company generate? The second one is, how fast can it grow the business? And the third one is, what is the timing of that return and that growth rate? And in tech, the ranges for those three variables is enormous. If you think about the return, we essentially own a lot of intellectual property business models. They can sell whatever they like 1 billion times over, and they still got exactly what they started with. So the marginal return for success can be, in effect, infinite. But if they get it wrong, the marginal return for success is negative. So you've got a range of negative to infinite. That's about as big as it gets. The second thing is that growth rate. We all know some tech companies can grow at 200% a year, but at the same time, I've seen semiconductor equipment companies lose 60 to 70% of their revenue in a single month in October 2008. So you've got a vast range of potential growth rates. But the worst of all is the timing, because that's the one that really matters. And the only thing that matters on timing is, what is the date that this company's product becomes obsolete, that someone else can do something pretty much as good or better? Is it the summer of 2023, or is it the summer of 2043? And that will give you the valuation of the company. It's that one factor can give you any valuation you want. So establishing an absolute valuation for a successful tech company is futile. But I'm fascinated by valuation, because what it does is tell me how excited people are. And if a stock is trading at 200 times next year, or the year out, adjusted fantasy earnings, which really are a bit pink and fluffy, and all the nasty stuff's been taken out, everybody is so excited that I'm probably never going to get more excited than them. So there's no point in owning the stock. If it's trading at 3 times next year, it's probably going bankrupt. So I'm not interested in that one either. But if it's somewhere between 15 and 50 times earnings a year or two out, that's fine by me. It depends on the business and the type of model and what I think the upside is. But I'm not really too fussed about valuations in that range.
Right. Fascinating. I think it's a very important factor, even when we look at internally, where companies, the cheapest slot generally doesn't make money, as you said. And it's the second best probably, or the second lowest, which interests us as well. William, one question: how do you identify or put 4 walls around saying that this is an enabler business? How do I know that whether an Alphabet is an enabler, or an Nvidia is an enabler, or what are the boundaries that you put? Because these are behemoths; they are so large and they operate in so many different areas today in terms of technology. So give us some corners to think about.
Yeah, so I mean, clearly it's not as black and white as I say it is, and some companies are both. So let's think about Amazon, for example. Amazon is both an enabler and a disruptor, because essentially I have 2 businesses. We all use Amazon Marketplace. That's a disruptor. If you're a retailer and you don't look like Amazon, you're already dead. It's destroyed the retail market. It grows very fast, very exciting. Everyone uses it. It makes almost no money at all. It's not about profit. So Amazon Marketplace is not about making money. It could make money if it wants to, but it's much more focused on growing into new geographies and product categories as fast as possible. So that's what disruptors look like. They grow very fast. They're very exciting. They don't make much money. The other side of the business is AWS, public cloud business. This is an enabler. It enables other businesses to make very efficient use of technology. It is phenomenally profitable. That's where all Amazon's profits come from. So when we owned Amazon, we don't at the moment, but when we did, we owned it purely for AWS, for the cloud business. We're not interested in the marketplace, the disruptor. We're just interested in the enabler. That's where the money's coming from. But then we came to the conclusion a couple of years ago that actually Microsoft was far better positioned going forward in public cloud than Amazon was. So we essentially moved that investment to Microsoft, which is why it's our biggest holding. So that will be one example of what you would think about. But essentially, one key difference is, what does the company do? What does it sell? Does it sell technology? And technology is semiconductors, hardware, software, services, and networking equipment. If it doesn't sell one of those, it's not a tech company. If it's selling something else and it's using a lot of technology, the chances are and it's successful, then it's a disruptor. Basically, it's taking technology and it's using it to disrupt another industry. The companies that are enablers, the ones that we're looking at anyway, are the companies that are selling those technologies, those 5 categories of technology, to everybody, including the disruptors.
Understood. William, one more question. You own a lot of semiconductor companies. As you said, companies either sell hardware or software. And recently, last 2 years, because of the semiconductor supply issue, there has been I think the semiconductor ETF index itself is one of the best performing index on any time frame. Do you think this is a short-lived phenomena, or do you think there is a trend which is still ahead of us? How do you see this space?
Well, there are plenty of trends there. So, and there's lots of different things. So we can talk about the semiconductor shortage, and we can talk about the long-term trend and the different trends within the semiconductor industry. So I suppose we could start by saying there are essentially 4 elements related to the semiconductor industry. One is the equipment companies that supply the capital equipment to the other semiconductor companies. We love those because they are taking an increasing share of the value of the semiconductor industry. So all the intellectual property about how to make a chip, almost all of it, is now held by those equipment companies, not by the chip makers. And semis themselves are taking an increasing share of the world. So semi equipment is a great place to be, and that's why it's a big chunk of our portfolio. The next group would be to think about logic chips as opposed to memory chips. So logic chips, these are the chips that think, that make the decisions, and memory ones that hold the data while you think about it, or to wait until you next need it. And that could be volatile or non-volatile memory. So in your phone, you have DRAM, that's volatile. That's the memory it's using for what it's doing now. And then you have flash memory. That's the equivalent of the hard drive on your old computer. That's the long-term storage where you stick stuff. But essentially, it's the memory semiconductor market, which is quite distinct. And then the third section is the analog industry, which is chips that basically interpret between the analog world that we live in and the digital world that the computer lives in. And without at least one analog chip, no computer can understand the world. That's absolutely key. You have to have at least one analog or mixed signal chip between the two. So if we think about those 3 categories of chips, the memory one is essentially one of the most exciting commodity markets in the world. Essentially, you can swap one flash chip for another, you can swap one DRAM chip for another. Some are faster, some are more expensive. Quality is normally pretty similar. They all do essentially the same thing, and they're all pretty much pin compatible. So this is essentially a commodity market where there are different grades of product. It's also incredibly capital intensive. So if you're in this market and you don't operate at least one leading edge fab, which will have cost you up to around $20 billion now to build from scratch, if you don't have at least one of those leading edge fabs, you will have a product that is both more expensive and slower than Samsung's product. And that product will therefore become almost unsaleable. You might be able to sell it breaking even, but you'll probably make a loss on it because Samsung is setting the price with its leading edge fabs. That means that everybody has to keep building leading edge fabs, whether they know there's demand for it or not. They just keep building. So last year, during the COVID crisis, memory fabs kept on going up because if you didn't have a leading edge fab, you were toast. So they just never stopped building. It's a very value destructive industry then at times because there's too much capacity comes on in big lumps for the market to absorb. No one has any option. It's a prisoner's dilemma. It's always worth building that new fab, but it destroys the business of everyone else around you. So they then do the same thing to you. So it's not a value creative and it can be very value destructive. That's not a market I like to be in. What I would like to do is sell them the equipment. So our big position in Lam Research is because basically Lam Research is the equipment company most exposed to the memory market. That's why people don't like it, which is idiotic. Because what wouldn't you like about the company that sells more capital equipment to the world's most capital intensive industry that can't stop buying the stuff? Why wouldn't you want that stock? So we have that stock, and that's why it's such a good long-term performer, despite the very low valuation that everybody seems to attach to it. And then you move on to the analog chips. As I said, they are key to the translation between the digital and the analog world. So if you think about direct connection, That's absolutely central to it, because the computer needs to understand the world now, because there isn't a human being there interpreting anymore. And that's why the analog companies have gone from around sort of little tiny, very profitable, quite interesting, but very small little businesses, $1 or $2 billion market cap companies when I started in the late 90s, to now being in the hundreds of billions of dollars in some case. Very quietly, these very boring companies that no one is interested in have gone from being $1 or $2 billion companies to $100 billion companies in about 2 decades. And that's not a coincidence. That's because they are key to direct connection. So again, we have a lot of exposure there because they're just on the right side of history, and they're dull, and they're incredibly profitable and not capital intensive at all. They are just wonder stocks as far as I'm concerned. So we have a lot of exposure in analog. And then you come on to logic, which has lots of subdivisions. So what we have are some specific logic companies where there's a very good story, and other areas we completely ignore altogether. And logic is the area where you've had the issue, or one of the areas where we've had the big issue with semiconductors in the last year, because people didn't know whether there would be demand for chips as the crisis closed in 2020. So they stopped building. Why would you put $20 billion into a big hole in the ground if you don't know there's going to be demand for that chip when you finish it in 3 years' time? So people stopped adding logic capacity for 6-9 months as the crisis was unfolding. But the problem is, at the same time, demand for technology was taking off, as we all know. So the demand for chips, because every bit of technology in the world requires at least one chip and maybe tens of thousands of them, demand for technology was taking off and no additional supply was being built. And you have to build supply just in normal times, let alone if stuff is taking off. And that's why we are now shorter of semiconductors at any point probably in history. So this is the worst semiconductor crisis that anybody has ever seen, and is not something that gets solved in 12 months. So anybody who thinks that the capacity that people started building in February last year will have any impact on supply in the first half of this year, they just don't understand how the industry works. So at the moment, the lead time for ordering semiconductors is increasing. It appears to have increased by another week last month in December. So that it's getting worse, not better. And that lead time is now 6 months. So if you want to build something that involves semiconductors or chips, which is almost anything that's interesting at the moment, you have to order the chips now that you're going to need basically in the second half of this year. That's a real problem. That's why you cannot get cars, truck chassis, all this stuff, Xboxes, because the chips have got a 6-month lead time. And it's going to take a long time for that to clear. So the semiconductor issue is not going to go away. The short-term issue, that's, I think, going to be there for the rest of this year, and then and possibly longer. That doesn't mean to say you want to be overweight semis for the whole of that period, but the actual underlying fundamental situation will hold up for the rest of the year. And the long-term trend for analog, for semiconductor equipment, and for some of the logic stocks is incredibly clear as well. So that's why we have a lot of exposure to semis. Our exposure tends to range between 20 and 40%. Probably everybody else ranges between 5 and 20%. So we are much more exposed to semis than most people. At the moment, we are still at the very top end of that range, the 40% end.
Sure, great. Yes, William. William, when I speak to you, I'm reminded of Dr. Strange from, Marvel, and how he removes and goes deeper into what he wants to focus on. We started off with investing, then we said why technology, removed the other parts and focused on technology. Then we focused and said that enablers are something which makes money. And you explained one of the segments, semiconductors, which are the key. What other segments do you think are very, very plumb to sit into this category of enablers? You said people who sell hardware, people who sell software. Are there any categories which are still developing and will develop over the next 5 to 7 years, which fall into this bucket of enablers?
Yes. So, well, we hold stuff from across the whole of the sector. So we're not, we have lots of nice semiconductor names, but we're definitely not a semiconductor fund. So we've got to find at least 60% of something else. And we don't have any difficulty. So there are some excellent services companies, some really good software businesses. There are some good hardware companies, but that's quite difficult. The hardware industry is basically being eaten by software on one side and semiconductors on the other. And some networking names potentially as well. So there's stuff out there, but what you're looking for are very profitable companies where those profits have got strong barriers to entry, and so no one can steal them away. They're going to grow, so the supporting trend, and no one else has got their hands on it, so that most of that value that's being created by the business is actually going to the owners of the company, the outside shareholders, not to insiders. It's not being blasted away on acquisitions or whatever. So we want to see essentially gap profits and mid to high teens growth of the gap profits. But you can find a few companies in all areas of the market. Software is a really productive place because a software company that's running well, it's got a product that's good, that's in demand, that other people can't replicate easily. That's an incredibly profitable business. Software is one of the great business models of all time. But the problem is that geographically, there are issues with software companies that operate in and around San Francisco and Silicon Valley. And that's because of this stock option culture, which is completely poisonous and which is totally overlooked by everybody else in the sector. So the vast majority of the value, often more than 100% of the value, in fact, for a lot of exciting software companies that operate in Silicon Valley, is going to the engineers, the software engineers. It's not going to the owners of the company. And I've got charts that can demonstrate that in a vaguely amusing way. But essentially, this company is not being run for us. It's being run for the people who work for it. And sort of quite right, too, because they're the ones that are adding all the value. So the value of a software company comes from the heads of the engineers. The value of a semiconductor company comes from the fabs it owns and the designs it has. And that's very different. So they don't have to overpay their engineers, and they're not based in Silicon Valley. That's a stupid place to put a semiconductor fab. So they don't have this options issue. But a lot of software companies do, and people are completely overlooking that. So these companies are not businesses. They are charities for San Francisco engineers. And that's why San Francisco is the most expensive place to live in the world.
Right. William, how do you differentiate between, let's say, a trend which is sustainable or a fad which is probably going to go away in a few years? And I know, talking to you previously, you've said that you don't want to buy these ultra high growth companies. They dig their own grave. How do you differentiate between these two ideas?
Well, I suppose you sit and wait for a while. So I don't tend to get very enthusiastic about ideas on the first hearing or the 10th hearing or the 20th hearing. If people are really excited about metaverse, I'm probably going to look at something else, because it's probably everything that's buyable in there is being overbid, and lots of the stuff won't be worth anything anyway, because in the long run, it's not going to make any money. So, I'm beginning to forget the question now. Remind me what the question was. Sorry.
How do you avoid the high growth, hyper growth companies, and differentiating between a fad and something which is going to last for a long time?
Yeah. So things that last a long time, you've got a long time to get involved. So you sit and wait. And most of the things we're invested in have been, strong drivers for many, many years. None of these companies are doing something completely new, which makes it look very boring to people. So people expect to have lots of new stuff in the tech fund. And actually, that's the last thing you want if you want to make money in public markets, is stuff that's new. You want to get stuff that's incredibly profitable, and it's going to go on doing what it does now better than anybody else for a very long time. And that's a great combination. The company that's doing something new, the chances are it's not going to be new for very long, and then someone else will come along with something even newer. So there are 4 problems with really high growth companies. The first one is that ultra high growth rate is going to slow down inevitably at some point. And when it does, the stock is going to fall like a stone, and it's difficult to predict when that happens. So they're just very risky stocks. The second problem is that companies that are run for really high growth are not run to be profitable. So let's think of an example. We'll take WeWork as an example. WeWork was run from day one with a single aim, and that was to grow as fast as possible, because that's how you attract venture capital money. And it did a very good job. It grew incredibly fast. It attracted a lot of money. And then it forgot to grow up and become profitable. In fact, worse than that, it didn't really forget. It was told not to, because SoftBank's Vision Fund came along and said, here's another $4 billion, but you can only have it if you promise that every decision you make from now on will maximize growth, whatever the cost. So from an economic point of view, they make some really stupid decisions. And once you've run a business like that for a few years, it is almost impossible to convert it into an inherently profitable business. So a company that is run for high growth is generally not run to be profitable, and they are just totally different types of business model, and moving from one to the other is incredibly difficult. The third problem with ultra high growth companies is they're extremely obvious. We can screen for them on Bloomberg or whatever you like, so we all know exactly who they are, so they're all too expensive. But the fourth one is the best as an investor, and that is there are always more of these companies going down than going up. So in 2020, Tesla was the most amazing performing stock. We didn't own it, and we simply didn't care, because the amazing performer from the year before and the year before and the year before and the year before are all going down. So if you're in none of these ultra high growth companies, you're already ahead of all your competitors and all your benchmarks, and you haven't even turned up at work yet. So it's just not worth looking at them in our view. So it's an area we completely ignore. So really, stocks that are growing at 200% a year don't interest me, because the chances are no one's going to make any money on them in the long run. Because you've got to remember, these things are businesses. They're not bundles of technology. And actually, that's worth saying. There is a fundamental problem, a misunderstanding of what the job of a technology investor is. People think the job of a technology investor is to invest in technology, but it's not. It's quite clear. The job of a technology investor is to invest in technology companies. And a company has to create value for its outside investors at some point in its history, or it's worth nothing. It was never worth anything. It never will be worth anything. Now, you might be able to buy and sell the shares for a profit at some point along the way, but that's largely a matter of luck, and it's very difficult to do it consistently. But that's what everyone else is trying to do. So everyone else is essentially taking other people's money from their investors, and they're using it to buy stakes in businesses, which are, in my view, fundamentally worth nothing. But they're hoping to sell them on before anybody notices they're worth nothing. And that actually doesn't work very well. What we're doing is completely different. We're taking other people's money from our investors and we're using it to buy stakes in businesses which are extremely profitable. So they're worth a lot of money today, and where we believe those profits will outgrow the market for years to come. So they'll outperform for years to come. And that works, as you would expect, quite well, because that is traditional investing. That's what everybody is meant to do in investing. But it works even better in this sector because no one else is trying to do it, because everybody misunderstands what tech investing is about. They think it's about buying exciting high growth stories of companies that are changing the world, often outside the tech sector. And they miss the fact that all of those net out at less than zero. So just ignore the lot. So that's what we do.
Understood. After applying so many filters, William, I think you already drilled down to a few companies which you like, and they show profitability. One important question: how do you decide when to exit? What is your framework? Because I think it's tough to, after doing so much analysis and understanding, how do you understand that you want to, the story's over and you don't want to participate anymore?
So I think what we're doing is we're owning companies which we are pretty confident will be worth a lot more money in 3, 5, 10 years' time. So a long way out in the future. So the first thing is, if we are now in serious doubt about that long-term trajectory, we don't want to own the stocks. So we're not going to hang around waiting for an opportunity to trade out. If that long-term business case is now broken or in serious doubt, or it's underperforming and we just don't understand why it's underperforming, we simply sell it. We're not here to take unnecessary risk. We want to buy dead certs, essentially, almost dead certs again and again. That's what we're looking for. So if it looks unexpectedly risky or we don't know what's going on, then we'll just get rid of it. And if 6 months later we suddenly realize why it was underperforming, I'm quite happy to buy it back higher, but I've never had to, because there always was something wrong in those circumstances. So that's one reason we might sell, because the story's broken or we don't know what's going on. The other might be that simply we've arrived. So we've now got to the point where actually that long-term story is in the price. We're there. It's not a 5-year story, it's a 6-month story, at which point it's just too tired. We need to be somewhere else. And hopefully we would have got out before that. So I want to see a multiple year trajectory for this story with pretty high confidence going into the future. And if that is in doubt because it might be broken, or in doubt because it's too short, then we'll be gone. We'll be in something else. But we won't do it on a single day. We'll probably, if it was a highly rated stock, so we have a sort of grading A to E. If it was a B stock, then we might move it down to a D and then eventually to an E, and then it's gone.
Okay, got it. I'm getting a number of questions. I'll try and curate them and ask you. One of the questions which is repeatedly coming is, do you focus on what's happening with what the Fed is doing in terms of tapering interest rates? Is there an outlook and plan to look at these factors and deploy them in your strategy?
Yeah, I think we can probably get rid of the slide if that's still up for everybody. I don't know what everyone can see them. So interest rates and ending of tapering and inflation, they're all worries that people have at the moment. So I think the first thing to say is that interest rates don't rise in a vacuum. Interest rates go up, not just because the Fed decides to raise interest rates, but because it's worried about something, and generally because it's worried about overheating or inflation. And actually, a hot economy and a mildly inflationary economy, I'm not talking hyperinflation, and I'm not talking absolutely boiling economy, but a really strong economy with a decent chunk of inflation is not a bad environment to be a tech company. That strength of economy means there's demand being generated. There's people who need to invest in stuff, and most of that investment is heading to the tech sector, nowhere else. So that's good for my companies. And inflation, if you are a company with good barriers to entry, pricing power, selling something that people want, actually inflation, as long as it's not hyperinflation, gives you quite a strong position, because you can raise your prices faster than the rate of inflation. You can hide basically those price rises and actually increasing margin. So in general, companies with pricing power don't do badly in an inflationary environment. What we don't want to cause is a complete disaster of an economy, and then everyone puts the brakes on hard, and that's not good for anyone. But that isn't today's problem. I don't think that's where we are today. Another thing about interest rates is that people say, well, okay, but it impacts the DCF, which it does. So a DCF, essentially, you're discounting future cash flows with an interest rate. If that interest rate rises, then the value of cash flows further out falls. And the further out those cash flows are on balance, the longer duration the stock is, the worse it's going to be, in theory, with the DCF. So if you're buying a stock which has got no profits today, but you're hoping it might be extremely profitable in 10 years' time, so this is the disruptor stuff, profitless, exciting companies with very high growth of revenue and no profits today, but one day they might be, then a high interest rate could destroy the valuation. If you're even slightly interested in the theoretical valuation, it's going to get harder with a higher interest rate. But that isn't what we own. We own companies that are very, very profitable today. So a great chunk of that DCF is in the near stuff. It's a lower duration stock from those names. It's still got growth. So there's still stuff far out on the DCF chart, but most of the value is going to come from the in years, and that they are less impacted by the interest rate. So as I say, interest rates go up. They will, of course, have a negative effect on the theoretical DCF valuation, but they don't go up in a valuation in a vacuum. And that DCF, the numbers are going to be getting bigger because it's not a bad environment to be a successful tech company and with big barriers to entry. So I'm not too worried unless it collapses the stock market completely, or we go down to hyperinflation or something of that sort.
Understood. So I think maybe taking a leaf from what you said, that probably tech spends are not going to be impacted so much, and this space is probably going to see a lot of technological spend by other companies, and therefore the secular trend will continue. William, one question: how do you construct your portfolio? Do you follow a concentrated investing approach, or how diversified are you in terms of your approach?
Okay, so we hold 30 to 35 stocks, which in my view is about right. So we could add some more names in, but to be honest, we own the ones we want. And I think having more than 30 names is reasonable diversification. I wouldn't want to go below that. So when we buy one of our companies, we're going to own it for many years. And we give it a rating. Normally, we're going to give it a rating A to E, and an A is a 5% weight, and an E is a 1% weight. There aren't many A's or E's, they're mainly B's to D. So it's quite a flat portfolio. Most of our stocks have a 2.5 to 4% weight. That long-term target weight doesn't change, or it probably doesn't change for a very long time. But at any moment, it could be a B plus or a C double minus. And those pluses and minuses are our short-term adjustment to those long-term target weights. And what we're doing here is differentiating between risk and volatility. And as I said earlier on, risk and volatility are completely different things from our point of view. BlackRock would disagree with me, treats them as the same variable. But from our point of view, they are two totally different things. So I don't like risk. I love volatility if the long-term trend is positive, which for our stocks, we believe it is. So as I was saying, we don't buy a stock just because it's cheap. Value investing doesn't work in tech. And we very seldom sell a stock just because it's expensive. If one of our stocks does well, we basically make it a minus. We take half the money out, but we leave it in there because you don't want to bet against that long-term trend, which is what you're doing if you sell the stock. And if it does badly for a while, we check, is this risk? Sell it. If it's volatility, though, we'll make it a plus. We'll double it. And we're doing that all the time in the background, not all the time. We're basically doing it about once a month in the background because we can do it without materially increasing turnover because the fund has constant flows. So there's at the moment, there's always cash coming in. That's lovely. But it works just as well with cash coming out. It's just not as much fun as you can imagine. But basically what we do is we wait for the cash to build up to say 3%. Then Rupert, my co-manager, and I go through the portfolio. We check that all those adjusted target weights are still what we think they should be. And then I use that new cash to take everyone back to target weight. And that normally doesn't require very much, if any, selling. So it's almost always just adding to the stuff that's underperformed, and not adding to the stuff that's outperformed. So we can trade against volatility, which is what we're doing there with these target weights, taking it back to target weight without increasing turnover, because that new cash had to be invested anyway. So that's how we can keep the turnover of the fund to around 30% a year while trading against volatility. But that trading against volatility can add a lot of value. So my rough calculations are that 2020, that trading added between 4 and 5% to the performance of the portfolio against a buy and hold at equal weight type portfolio over the period. So it adds value. It doesn't increase much turnover, but you just have to keep a track of what that target weight is and the adjustments to it. And that's what people don't do. They forget where the weight started, and it drifts up with success. So they have ever more in a successful name, and it drifts down in the stocks that are underperforming. So they have ever less in the ones that hopefully have a catch up coming if they're right. So it's always going the wrong way. We're just constantly adjusting both of those back to where they should be, so that when those moves reverse, we get more than our fair share of the benefit.
Sure. I think that readjustment adding 400 to 500 basis points is just fascinating. William, are there any size considerations? Do you look at small cap, large cap? Is there a bucketing that you do?
Yeah, so we don't do small cap. So when I was leaving BlackRock, I had the delightful opportunity to spend a few months with all the systems. My departure was, amicable and everything like that. And I could use the systems to analyze what I've been doing and what had worked. And one of the things I realized hadn't worked was investing in stuff below $1 billion in market cap. It was very clear that all those names that invested in, some had done well, some had done badly, and it all netted out at almost exactly zero. So they didn't cost my investors anything, but they didn't add anything. So it was tying up capital pointlessly. So we just don't do it. I'm clearly not a natural small cap investor. I tend to get excited about stuff too early with those stocks. And by the time they get it to market, which is always a year later than I expect, someone else can do it almost as well. So it suddenly turns from a monopoly into a competitive situation, and it just doesn't work very well sometimes. So we don't do any small cap investing, and we don't really do very much below $10 billion. So the prime focus of this fund, half to 2/3 of the capital typically, is in the $10 billion to $100 billion market cap range. Now, $100 billion sounds a lot, but compared to the mega caps, it's tiny. So to me, a mega cap in the tech sector is currently, it's about 1% of the S&P 500. That's my guiding rule. And that currently is around $350 billion in market cap. And there are 13 mega cap tech-related companies in the world, and they dominate all passive tech funds and most active tech funds. And that's just missing the sweet spot of the market for two reasons. First of all, mega caps, if you've got a portfolio that's half mega caps, what you own is a portfolio of the winners of the last round of disruption, because that's what mega caps are. And the history of the tech sector is that they will collectively lose the next round. They've got the share to lose. So don't own a basket of mega caps. It's pointless if you're thinking anything more than sort of 6 months ahead. And the second thing is that range, the $10 to $100 billion cap range, is the sweet spot of the industry. Because a $10 billion company is an enormous business. You've got all the liquidity and all the information you could possibly want as an investor. But if he gets it right, it can turn into a mega cap. And that's an increase in value of 35 times or more. And that can happen in a surprisingly short period of time for a tech company. So you've got all the advantages of large cap investing in that $10 to $100 billion market cap range. But you've got the potential for huge increases in value in just a few years if you get it right. So why wouldn't you focus on it? And yet no one does. Everybody focuses on the very biggest and the very smallest companies. And those ones in the middle are just sort of left to be the ballast in portfolios, not realizing that's the best bit of the market. So we have mega caps, and we have some, big large cap companies, 100 billion to 350 billion, but most of our portfolio is in that 10 to $100 billion market cap range.
Very interesting, William. I think this idea of looking at the sweet spot, I think, is very interesting. And also your filter looking at 1% of the S&P is also, I think, something very, very interesting. I learned something new today. Now, William, a two-part question. One, is there any sense to look at your portfolio in terms of the geographical spread? Where is the company incorporated? And secondly, we had some episodes in China last year, some regulatory changes. What is your opinion about that? How do you look at these risks in your portfolio?
Yes. So from a geographic point of view, in my view, very simplistically, this is the world's most global industry. Despite what's going on between China and the US, it still is. And so it's almost pointless to look at most of the companies from a regional or country point of view. It just makes no sense at all. So we don't, as a view. We're heavily overweight. We're heavily invested in the US. So maybe 2/3 of the fund is in the US typically. That's still less than most of the global benchmarks. That's not because we don't like the US. Or most of the key intellectual property is still in the US. It's because we don't particularly like the mega caps, as I said earlier. And the mega caps are mainly US. So that creates a huge weight in the US side of any global tech index. But we love finding stocks in Asia, in Latin America, in Europe even. We managed to find a few. It's difficult to find anything really exciting in Europe, sadly, but there are a few out there. Hoping ARM might come back at some point. So geographically, we'll appear to be tilted towards the US, but we're looking at this from a global point of view. We want to own basically the companies that are pretty much the best at what they do in the world. Then from a point of view of China versus the US, the world was gently bifurcating again between China and the US. You could see that slowly happening even before Donald Trump arrived in the White House, but he clearly accelerated that. And whatever you think about Donald Trump, and I am not a fan, I'm afraid, but whatever you think, one of the things I think he did get right was that China was abusing its position and was a threat to Western technology companies and the health of the Western technology industry. That dealing with that now, I think, is pretty much accepted on all sides of US politics, and lots of Western countries and governments are now on board with that. So China is, as far as I can see, hemming itself in by becoming more aggressive rather than less aggressive. And quite a lot of what it's doing seems to me to be handicapping its own tech companies now and not advantaging in them. So I think we've just got to accept now that they are largely two separate tech industries in many respects, particularly nearer the leading edge. And that's not particularly efficient from a global point of view. It's quite good for some of my companies because there's duplication. So, if the Chinese want a semiconductor industry and the West wants a semiconductor industry and they're not allowed to overlap and share capacity, that means you get duplication. That's twice as much equipment. So my equipment companies are selling twice as much equipment. It's very healthy for them, even if it's not very good for the consumer or for the economy. What would be horrific is if China invaded Taiwan, where most of the world's leading edge capacity is located for semiconductors, or if North Korea sent a series of missiles across the border to South Korea, where again the other big chunk of leading edge semiconductor capacity is located. That's why there are huge subsidies being offered by governments around the world for, in particular, TSMC and Samsung to start building semiconductor fabs outside Taiwan and away from North Korea, in Europe, in the US, in Japan. And you can see that going on. Again, that's quite good for some of my companies because those huge subsidies were encouraging big spend on semiconductor equipment. My companies are quite happy to sell you that semiconductor equipment, so they're on the right side of that as well. There's all sorts of nice reasons to own semiconductor equipment companies at the moment. So that sort of thinking about the Chinese bifurcation, but you can't deny the Chinese are very, very good at certain bits of technology. So particularly artificial intelligence, machine learning, that sort of stuff. Although the Chinese government is restricting now one of their advantages, which was the ability to use, in our view, probably abuse mass data from populations without the permission of the people that data belong to, but that's by the by. But one thing they don't do is semiconductor equipment. So there is no leading edge semiconductor equipment industry outside the US, the Netherlands, and Japan. So if you want to build a leading edge fab, you have to buy stuff from companies from one of those three countries, and probably all three of them. And one other thing to talk about on the macro side, which is Ukraine. There's always something horrific potentially around the corner. At the moment, this week, it looks like Ukraine, we could have an invasion. That's not good for markets. It's not good for anything, really. So hopefully it doesn't happen. If it does, things probably go down for a while, and then it might be back up again, because it doesn't change the long-term story from the tech sector's selfish point of view, that tech is still at the heart of everything that's going on in every part of the economy. And so the macro, the geopolitics have short-term impacts on markets, but the long-term trend of tech outperformance, that pale blue line going up to the sky and everything else going sideways, that isn't changing dramatically. And I think in the rest of my investing career, to be honest.
Sure. William, if you were to talk to an investor who is coming to your fund, what kind of horizon should he carry? What do you want to tell him? How to prepare his expectations?
Yeah, well, I'd start by saying, you can look at the monthly performance on our fact sheet and you'll see there's only one down month in the last 15. Don't think we can keep that up. So that's insane, to be honest. We've got a cumulative, annualized performance since launch of over 30% after fees. We can't keep that up. That's impossible. Do not think we can keep 30% a year up into the future and not have any down months. Every year we will have at least one 5%, 10%, possibly even worse month. That's just how tech works. And then the trend is so strong, it will bounce. So that's the buying opportunity. But it's not worth waiting for that buying opportunity, because it normally won't come until you're higher than you are today. So So that's the first thing. Don't try and time it. The trend is simply too strong to time. But don't believe it's going to be a smooth upward path like it's been for the last 15 months, because that's just insane. That just shouldn't happen. What I would expect, and there's no guarantee, but my expectation is that we continue with the mid to high teens annualized net return that this strategy has provided for the last more than 10 years across, first of all, BlackRock and then BlueBox. That is sustainable because that 15% underlying growth of the tech sector is sustainable, in my view. That's the pale blue line, the slope of the pale blue line. And we think we can beat it by a couple of percent each year. So that gives us a mid to high teens annualized return. So I think we can keep that up. I can't guarantee it. And there'll be years which are far worse than that. And hopefully there'll be years that are better. But we've had 3 amazing years in a row now. A bit much to think that 22 is going to be as good. But then I said a year ago, after up 63% year, we can't possibly have a plus 30, and we had a plus 33. So, who am I to tell?
Yeah, interesting. William, one last question to you. How do you do your own asset allocation? How do you invest your own money? I think that will be fascinating for our people to know.
Okay, right. So when I was at BlackRock, I had a huge advantage. So I was thinking about my pension and stuff, because I could, as it were, insider trade entirely legally. Because what a useful thing to know is, if you invest in mutual funds, is that fund manager on the ball? Is it the same fund manager we think it is? Or is he actually retired to his island in the Caribbean? So working for one of these big firms, you do have a little bit of insight. That fund is actually on fire. I'm going to invest with that. Or that fund manager, actually, no one's noticed, but he retired last year. So there was a little bit, you could do a bit of moving between funds, but I didn't do anything too dramatic. I've essentially got a bit of exposure to a bit of Europe, a little bit to the UK, not much, sadly. A big chunk of my portfolio, so the biggest single asset I own is my exposure to my fund. I have a house, I have a little farmland around it, so that's a bit of diversification, to building up a bit of holiday letting business. That's nice and diversified away from the city. So a bit of diversification. Something like my fund should not be 90% of your portfolio. It's too volatile. However good a case I make for it, it's simply too volatile. It should be an interesting thing that you have a bit of. Big bit, in my view.
Great. William, thanks a lot for joining us today. I think it was very, very fascinating. I learned a lot of new things. I'm sure people who would have watched this whole last one, I would have learned a lot of new things. Thank you. And we'll probably, get you back up here again in the next few months, and we'll have a chat with you again. Thank you, and look forward to you speaking to you again.
Absolute pleasure. Very good to speak to you. Thank you very much.
Thank you, William. Thank you, everybody, for joining in. Thanks for logging in. Bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.